Hello everyone, especially trading terminal subscribers. Another market recap. This is going to be a little different market recap because I want to spend the first 5-10 minutes, however it's going to take, and talk about collapse of SVB, Silicon Valley Bank. What happened, why it happened, who's at fault, and the Fed's action and what it means for the market and what it really means for you as a market participant, trader, investor, whatever it might be. So we are in really interesting times. It seems like we're in the middle of another financial crisis. Credit Suisse getting bailed out by the Swiss Central Bank. Silicon Valley Bank collapsed. First Republic Bank. These are banks I've never even heard of. I mean, besides for Credit Suisse. Silicon Valley Bank pretty much going bust. First Republic, Signature Bank, on and on and on. So I want to spend a little time before actually going to the market and really explain what happened at SVB, why I believe Fed shouldn't have stepped in and they shouldn't have supported depositors, and they should have let the market really behave in its normal course. But anyway, let's get started. A couple of things you need to know before you really understand what happened at Silicon Valley Bank. Number one is the accounting equation, which is asset equal liabilities plus equity. Now this might sound really daunting, but all this really means is that if your asset minus your liability is equal to your equity. If you can't really understand this, think of it this way. If you have $100 and you owe $50, so $100 is your asset, $50 is your liability, your net worth is $50. So that's number one that you need to do. Second thing that you need to know in order to really understand what happened at Silicon Valley Bank, and it's kind of an accounting term and a finance term you need to understand, is the relationship between interest rate and bond prices. We usually say it looks like a seesaw. So when the rates are down, prices are up, and prices are up and vice versa. So when interest rate goes up, prices come down. Why is that? Imagine if you have a loan and that loan has a 5% interest rate. So somebody's paying you $5 every year for that loan. If the rates all of a sudden goes up and goes to 25%, 30%, you only receiving $5 for that 100 that you lended to someone is not a good deal. So if somebody else want to buy that debt from you, they're going to buy it less than 100 because the market rate is 25% right now. So that's why the interest rate and prices have kind of a seesaw relationship. And the third thing that you need to know in order to really understand what happened at SVB is a little bit of accounting. So available for sales accounting versus held to maturity. Now, what do we mean by this? So sometimes some assets for a company, they're there because it's important. It's their day-to-day. Like for example, if GM, General Motor, or Ford buy some machinery in order to make cars, they're not buying that machinery to flip it in 2 years or flip it in 3 years. They need it for their operation. So they account for it as held to maturity. So the value of that asset comes down every year, they start depreciating, but it doesn't really matter to Ford because that asset is still making them car. There might be some situations where the asset is fully depreciated, but it's still in use. There is an accounting term for that. Available for sales, on the other hand, is something that you're planning to flip. So think of it as a rental property that you're thinking about flipping in a couple of years versus the house that you're living in, which is kind of the held to maturity. You don't care if the price of the house is going up or down. That's where you live. You don't really care about the prices. So you got to know these three things before we can really explain what happened at SVB. So now that we know, let's get into it. As you know, the start of 2021, interest rate went up. Interest rate went up by a lot. And if you remember, I said when the interest rate goes up, the prices of bonds actually goes down. The Silicon Valley Bank, which was, as the name really discussed it was a bank for Silicon Valley and startups, was getting massive inflows of deposit and deals in the 2020 and 2021. But as 2022 started and the rates were going up, deposits actually wasn't coming in, right? Because the VCs was a lot slower, so deposit wasn't coming in. So in 2020 and 2021, when they were receiving all that cash, they were like, what should we do with it? And they went and invested in like a 2% mortgage-backed securities. All of a sudden, mortgage rates are now at 7%. So what happens to their bond value? Their bond value went down by a lot. So if you remember that equation that I gave you, asset minus liability equal equity, all of a sudden the value of their liability, which is the customer deposit, stayed the same, but their asset value went down by a lot, which means their equity went negative. What does that mean? That means you're going under. That means your net worth is negative. That means you're pretty much bankrupt. You know, that's exactly what happened. They had a lot of assets that they were holding for held to maturity, but they had to let go. They had to sell them to raise some capital because they were seeing a lot of deposit outflow, and you know, people noticed, and it created a whole drama. So now, should have they been bailed out? The answer is no, and I'll explain why. This is something called interest rate risk. A lot of the banks can actually hedge. So when we're talking about bonds, there's two types of risk. There's credit risk. That means a company might go bankrupt. And then there's interest rate risk, which is also called duration risk with D. So they were buying mortgage-backed securities, so not a lot of credit risk, but they were having some interest rate risk, and they could have hedged that risk by something called swaps. You know, interest rate swaps, which they would pay a fixed amount and they would get back a floating amount. And yes, these hedges are not free, but they're necessary to run a bank, right? Running a bank is very difficult and very risky. They should have had this in place, but you know, in a classic Silicon Valley style, they wanted to disrupt banking, and they didn't have these hedging places, and they were offering really good terms for their deposit and really good terms for their loans because they were disruptors. For about 16 months, they had no risk manager in place. 16 months. Can you believe that? No chief risk manager in place. And, you know, when things got really bad and their equity went negative, as I explained, Fed decided to bail them out. Now, what this means? This means all the VCs, and this really has nothing to do with, you know, the startups and things like that, and I'll get into that. But all the VCs basically got bailed out because up until $250,000 is insured, and everything after that is going to come after the bank is seized and its asset is sold. FDIC said almost 50% of uninsured deposit could be recovered within the first week. 50%, that's enough to make a couple of payrolls. So this was really never about payrolls. This was really about, you know, protecting, in my opinion, Silicon Valley's. And yeah, so Fed step in the middle of QT, they stopped their quantitative tightening. Now they grew their balance sheet by about $300 billion, and they're supporting the banking system. It's really interesting times, really tough times. But you know, if you're a trader, there's tons and tons of opportunities, and we call a lot of them in our chat room in Bearable Traders. Like we sold some puts on Goldman Sachs because we felt like it's very oversold, right around one-time book value to tangible book value. There were a lot of great reversals, which a lot of our traders took. But this is the dynamic of the market. This is the later stages of bear market, and this is usually when accident happens. So, you know, really protect your capital and be very mindful of overall what's happening in the market. What do you think? Do you think I'm wrong on some of this stuff? Do you have other opinion? And remember, every time there's a bailout, even though they're saying the taxpayer is not paying for it, the taxpayer is paying for it. So who's putting the money in? The FDIC. FDIC is basically an insurance company. Big banks pay big fees to FDIC for that insurance. So now banks got to pay more to insure a higher amount. When banks pay more to FDIC, they got to make that money somehow. So they charge you more on overdraft fees, on delinquencies fees, on credit card fees. So at the end of the day, you are paying for this. And you're also paying for it, obviously, with higher inflation. So that's another thing. With that said, on the market side, again, ECB, European Central Bank, raised by 50 basis points. Market actually reversed and rallied. Again, you're going to get some really weird price action. On put-to-call ratios, you can see massive spike on put-to-call ratios, which means people are buying a lot of protection. So right around you know, beginning of February, around there, you were seeing massive spike in puts. So a lot of smart people were seeing that coming. Commodities are absolutely getting hammered down. Oil is at $68, Brent's at 74. Lumber was up today, but still a lot lower. So that's kind of pushing through a recessionary vibe. One last thing I wanted to say about the trading terminal, and one of the things that we've launched, and I don't know if a lot of people are actually looking at it, is if you go to your profile section, you can actually change from light mode to dark mode. So what you're seeing right now here is trading terminal dark mode, and it's something that was tremendously requested, and you kind of have it right now. That's about that. Next week we have Fed's decision. Consensus is about 25 basis point interest rate hike. We'll see what happens, but definitely interesting time. Make sure to protect your capital, and we'll see you next week.